Hey everybody, Kyle, not your average finance guy. Doing a follow up to a part two, if you will, for the last video I did where we kind of went through a velocity banking example. There's a couple had really good cash flow, and in I think it was just over 5 years, we knocked out like $418,000, something crazy. Freed up over $5,000 in debt payments that they were making their cash flow go sky high. So once you get there, like, okay, we're out of debt. They paid off their house, they paid off all their credit cards, they paid off 2 cars. Now what do? You got all this extra money. Like, this is what we all want. This is what we're all working for. Well, now what? If and when this you follow the system, and you really don't have to change your life at all. You just have to change where your money goes, and it's kind of like a workaround. You really don't change much at all. So if you're following that stuff, please keep going and get that figured out. If you got any questions, let me know. Please comment in those videos. I will try to answer those as soon as I possibly can. And but this is kind of the next step after we graduate from velocity banking. It's infinite banking. So the infinite banking concept is kind of the next step to build your wealth. Same exact thing as the velocity, same concept as the velocity banking, except now instead of borrowing against your house, you borrow against yourself. You borrow against your own assets. So what it is now, after we free up all this cash flow, and then what do you do with it? Now we start putting it into another vehicle. Okay, so you put that into your. You could think about it a couple different ways. You could put it into a savings account at a bank. Banks are, yeah, they're supposedly insured up to $250,000. I've heard a lot of stuff where there's nowhere near enough money in that FDIC insurance to possibly cover all the money that has been loaned. That's way past what their limits are, but I'm not getting into that. That's up to you guys. You can look into that if you want. But a much safer, in my opinion, a lot of people that I follow, their opinion as well, a much safer place to house your money is in it's a, I hate to say the word, but it's a whole life insurance policy with high cash value. So it's kind of it's stripped out. We take the insurance, the death benefit, and we take that almost down to nothing. This is meant to use while you're alive. Everyone, as soon as you say life insurance, oh, I'm out. Dave Ramsey says, you need to buy term and invest the rest. Well, okay, yeah, you can do that if you're worried about insurance. This is think about this as a vehicle. Stick with me here, and just think about this as a vehicle, as a separate savings account, but it's way better than a regular savings account at a bank, almost like it's on steroids. So just hang with me here and check this out. So per our last example here, that we paid all this stuff off. These were all their debt payments, costing them $5,000 a month. And this was just debt payments. Now, they still had a positive cash flow of $2,000 a month. So the way I just kind of throwing numbers at this, and this is not a policy design whatsoever. This is just throwing some numbers on paper or a spreadsheet. So what we did is we took all their debts, including their mortgage, and paid off $418,000 in 5 years, 9 months. Okay, so what happens after that? Now, after that, let's say that instead of what we were doing is we were taking all this money that we were making in debt payments and plowing it right into our home equity line of credit. We got that paid off. Now that is zero. So you still got your home equity line of credit of almost $50,000 if you need that at all. And you could use that to fund this policy if you wanted, or you can do it. I'm just going to show a regular kind of a dumbed down example here to keep it super simple. But let's say that you take 131 of that and you put it back in your cash flow, and you just add that up, so you got 2250 or so in free cash flow. So that is yours. You don't have anything earmarked for it. All of your bills are taken care of, plus you go ahead and spend $2,500 however you want. Let's take this $5,000 that we used to be plowing towards all of this debt payment, that there's never an end in sight, right? So instead of just plowing all that back into free cash flow and having a huge party every month, which could get you in trouble. Let's take that and let us build on something, okay? So if you do that, starting down here, if you take $5,000 and you deposit $5,000, if you deposit $5,000, you got $5,000 balance. And if you can earn 5% interest that month, you would have earned $20.83, okay? These numbers aren't that sexy, but watch what happens when we copy this stuff down, and let's look at it after 1 year, okay? After 1 year, we've got, something didn't work there, did it? Hold on. Okay, sorry. We going? All right. I didn't add in the deposit. So if we take the deposit now and we copy this down, now after 1 year, we've got $61,000, almost $500. Okay. No, my deposit has to stay the same. Damn it. Equals that. Has a mind of its own sometimes. Okay. There we go. So now we got 61.4 after 1 year of taking your money and just putting it into this vehicle, okay? So let's take that and look here. Now we are earning every month $255, okay? That's not bad. All right, back in the old days when we were paying all this interest here, look at all that interest we're paying. Now we are getting it. Now we're receiving it. So let's take this down. That's after 1 year. Let's copy this down 1 more year. At the end of 2 years, oh, that's always a good sign. We got to make our columns bigger. We got $126,000 after 2 years. Okay. Let's take this down. Let's take it to 10 years. If you did this, you've already been paying on this stuff forever. What if you just continued doing what you're doing and taking this out 10 years? We're copying this down to 120 months. $776,000 that you've got. By putting it in this vehicle, it earns you on average 5%. Okay, if you put it into a home equity line, if you put it into the IBC, the infinite banking concept, these policies generally return. There's a guaranteed dividend that they have to pay you, that they will pay you, but there's also a non-guaranteed dividend that is not guaranteed, but these insurance companies, they're mutually owned. They have paid every year through the Great Depression. So if they're paying dividends through the Great Depression, I think they got a pretty good business model, better than any local bank out there. So I think your money's pretty safe. So I use the 5% number. That's close. Some are, it's between 4.5 and 5.5, 6, whatever. I just use 5%, nice, easy, round numbers. But what would you do? You got everything paid off in 5 years. Okay? Let's go keep doing what you're doing, and in 10 years after that, doing nothing else, you've got $776,000 of cash value. Pretty good, right? And now, you know what you can do with that? You can take a loan against that, just like your home equity line of credit, and do whatever you want. You can buy a house. And guess what? A loan is not a taxable event. So you take out a loan for $775,000 and you buy a house for cash, and guess what? Now you have a loan, so you can repay it, but this is your bank. You own the policy. This is your cash value. So you set the terms on how you pay it back. Now what you probably should do is, how would you get a loan at any bank for that and try to make some payments back to that. Remember, you've got all this freed up cash flow from before, so this really will be no problem. But you can pay yourself back however you want. And guess what? You don't even have to pay it back. What's going to happen if you don't pay it back is it will come out of your death benefit. So when you die, you won't pass anything on to your heirs. Okay? But what's going to happen if you had a savings account that had $775,000 in it and you took the money out and bought a house? Nothing, right? Same thing. We just made $3,235 that last month in interest alone on that money, on that cash value. So it's kind of the same, works the same as a savings account, really, but it's way better. So in the end, You got $776,000 after 10 years of doing the same thing you've always been doing. Instead of making credit card payments and your own house payments, you're just plowing this into your infinite banking model, into your bank. So now, and at any point, you can take a loan against this, just like a home equity line of credit. You take a loan out against your equity in your house. This you can take a loan out against any single one of these, wherever you're at. If you want to take a loan out, you can usually take a loan out up to 90% of your cash value. So again, like 90% loan to value home equity line of credit, or 80% in this example. Most insurance companies is about 90% they'll let you take, and it's a loan against your cash value. You're not taking your cash value out. So let's say we'll go up here 2 years in, month 50, I'm gonna take out $80,000. Okay, so if you take out, I don't know, make much sense. We take out $80,000. Your cash value continues to grow like you never took anything out of it. Okay, it's almost like, would your house stop appreciating in value because you took money out of a HELOC? No, or it could go down in value, but this is guaranteed to go up. Okay, to me this is much safer. So if you took a loan out of $80,000, now yes, you're going to have to pay that loan back, and the loan is usually about, right now I think it's like in my policy it's 5.68% is the loan I have to pay back, and they're like, okay, well now you're losing money, but you pay this back at simple interest versus the compound interest that you're earning. So if you can let this go, let's delete this. If you can let this go for 4 to 5 years, say on 5 years you're gonna do yourself a little something, and look, you got $346,000 available. Let's say 5 years in, you take $100,000 and you go, I would buy an asset with it. I'd take $100,000 and invest it somewhere. And now if you took $100,000 and technically it's a loan, but you don't have to pay it back, but you should. If you pay it back, now you can always keep doing this, right? So if I took a $100,000 loan right there, now I'm not going to be able to go back the next day and take a $352,000. My cash value, just like your home equity line of credit, your house would be worth $352,000, but you already took out a $100,000 loan. So now that leaves $250,000 of room back in to take another loan out. So you take your loan out. Whatever, R. Nelson Nash wrote a great book, was it Becoming the Bank or something like that. If you take money out of your business, out of your cash value, just whatever it is that you took, maybe you bought a $100,000 car, I don't know, what would be the payments that you would pay that back at the bank? So just take that. Maybe the bank payment would be $3,000 a month. I don't know what it would be. So take that and then put it back and pay yourself. Pay your own bank back. I know this can get confusing. It took me so long to get my head wrapped around this, but the simplest way that this works is you put money into this vehicle. This vehicle will pay you. It grows. This insurance policy, the money you put in goes into a big pool where everyone else puts money into this big pool. So it's never your money you're taking out. When you want to take a loan out, it's not your money. It's the insurance's money, because you're borrowing against your home equity or your cash value. So I don't know. I hope there's a lot of questions on this, because this is, I know it's very confusing, but if you look at it in the simplest terms, which I try to get out there for everyone, this is what you can have. So, I mean, imagine worst case scenario in, what did we started? We got, we're 5 years, so 15 years from now, if you were these people, in 15 years, you were basically had nothing but your home equity, and you're paying $5,000 a month towards debt, to your debt payments, okay? 15 years later, you're not paying anything toward debt anymore, and you've got $776,000 available to you to use for whatever you want. You can take this money out for, you want to buy a yacht, go for it. A house, whatever it is, you can take this money. You have access to this money. You don't have access to $776,000. You'll have access to 90% of that. So let's see, equals that times 0.9. Okay, so you're only going to have access to about $698,000. So that's terrible, right? Sorry, my ADD here doesn't let me do this. I like the currency there. So you'll have access to about $700,000 in 15 years. Again, we started this video with what would you do if you didn't have any debt payments? Keep it that way for 15 years. Boom. Get 700 grand. All right. What kind of questions we got? Please let them come. I know they're there, and can't wait to help. All right. Have fun chewing on this one.